Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner, owner of Elevation Financial, on the web at elevationfinancial.com. We're going to talk today about debt to income ratio. What is a good debt to income ratio? What's it all about? Let's unpack it. So, debt to income ratio, or DTI for short, I may sometimes say DTI as an abbreviation. It's a financial metric that compares an individual's monthly debt payments to their gross monthly income. So, to understand your DTI, debt to income ratio, it's important to know how it affects your financial health, your loan eligibility, other factors in your financial life. Lenders use debt to income ratio to determine if they're going to lend money to you, how much, what your interest rate might be. So it's a big factor in our financial life. So to calculate your debt to income ratio, it's pretty simple. You start by adding up all your monthly debt payments. And this includes things like mortgages or car loans, student loans, credit card payments, any other regular debts, and then divide that by your total gross monthly income, which is your income before taxes and deductions. So the result is your DTI percentage, or your debt to income ratio. So for example, let's say you pay $2,000 each month toward debt and your gross monthly income is $6,000. Your debt to income ratio would be 33%, because $2,000 divided by 6,000 is 0.33, or 33%. So that means 33% of your income goes to debt payments. So keeping a low debt to income ratio is pretty important. It shows lenders you can handle your debt, makes you a more attractive borrower. It helps you get better loan terms, like lower interest rates or higher borrowing limits if that's a goal. It also benefits your overall finances. So it ensures you have enough money for living expenses, for saving, for investments, for retirement savings. A high debt to income ratio can strain your finances and cause problems when trying to reach your financial goals. So, what makes up a good debt to income ratio? So, to determine what makes up a good debt to income ratio, lenders have benchmarks to assess a borrower's financial health. So there's lots of different ways they can approach this, depends on the lender. But in a general sense, a debt to income ratio of 36% or lower is ideal. This means that your debt is manageable compared to your income in theory. Again, it's not a one size fits all, but it's kind of a general guideline. Again, another example, we'll use different numbers, but same example just to kind of reinforce it. So if your monthly payments toward debt are $1,800 and your gross monthly income is $5,000, your debt to income would be 36%. $1,800 is 36% of $5,000. So when it comes to debt, lower is better. So we don't want to just magically reach that 36% number by default. Lower is better if possible. I mean, a debt to income ratio of 0% is ideal. But if that's not practical, you want to aim for a DTI that's as low as possible. So when you're applying for a mortgage, most lenders prefer a DTI of no more than 43%. And this higher threshold accounts for the significant financial commitments of the mortgage. So if your monthly debts, including new mortgage, total $2,150, and your gross monthly income is $5,000, your DTI would be 43%. So some lenders, however, might require a lower DTI if you have a lower credit score or limited savings. Again, these are just estimates. I've seen cases where lenders will go up to 50% DTI, lots of different variation there. So other loans, like personal loans or car loans, might accept a higher DTI, sometimes up to 50%, like I mentioned. But a higher DTI can lead to less favorable loan terms, like higher interest rates, shorter payment periods, etc. So you want to remember that what a lender will accept is not the same thing as a healthy debt to income ratio. Most financial advisors will generally agree that a 28/36 debt to income ratio kind of benchmark is ideal. So 28/36 is kind of the metric we use. So what does that mean? It means that we want to try to spend no more than 28% of monthly income on housing expenses and no more than an additional 8% on debt, so that total debt service doesn't exceed 36% of your monthly income. So I'll come back to that again. Let's recap that. So housing expenses should not exceed 28% of your monthly income, and total debt service, including those housing expenses, should not exceed 36%. So 28% on housing, no more than total debt of 36%. So again, maintaining a low debt to income ratio can help you get better loan terms. Lenders see low debt to income ratio as a sign of financial stability, which can result in lower interest rates and longer repayment terms. Again, a higher DTI can make it harder to get loans or lead to less favorable terms. So also a good debt to income ratio also contributes to your overall financial health. If you keep your debt levels low and manageable, that ensures you have enough funds for things like living expenses, for savings, for investments, for retirement contributions. And this can ensure you have enough funds for goals, long-term goals like saving for retirement, buying a home. A high debt to income ratio can cause financial stress and can limit your ability to reach those goals. So you want to make sure you're improving and maintaining a good debt to income ratio throughout your life. It's really important for financial stability and again, better loan terms if that's a factor. So if you're trying to lower your debt to income ratio, pay down existing debt, use extra funds to pay off credit card balances, student loans, car loans, that will lower your monthly debt payments once they're paid off. You can also try the debt snowball, the debt avalanche method. I've talked about these methods in the past. They're ways of aggressively targeting and paying down debt faster. The debt snowball method, for example, targets smallest to largest debt, while the debt avalanche method focuses on the highest interest rates first. Either way is fine, depending on what works for you. On the other side of the equation, you can also increase your income. Increasing income can reduce your debt to income ratio because the income side of the equation goes up. So you can ask for a raise at work if maybe it's due, take on extra hours, find a higher paying job, look for a career advancement, possibly even start a side hustle or freelance to kind of supplement your income, even if it's only temporary. So by earning more while keeping your debt the same, you can lower your debt to income ratio and show lenders you can handle your debt well. So avoid common mistakes when working on your debt to income ratio. Don't take on new debt while you're paying off existing debt. Opening new credit card accounts or taking out more loans will only increase your debt payments and go in the wrong direction. Make sure you create and stick to a budget. I'm a big fan of budgeting, as you know. Track your income and expenses. Find areas where you can save money and use those savings to pay off debt. So maintaining your DTI over time requires discipline. It requires good financial habits. Live within your means. Regularly check your credit report for accuracy. Set financial goals. Build an emergency fund. All these things kind of integrate together, including your debt to income ratio. So again, it's not just about lenders. It's not just about loans. You want to make sure that overall your financial health is sound, and that's what a debt to income ratio can help you measure as well. So, just kind of some key takeaways. Improve your DTI by focusing on paying down debt, possibly increasing your income. Avoid taking on new debt. Monitor your debt to income ratio. Set financial goals. Set plans to achieve them. Build an emergency fund, which means you don't have to take on new debt. And then make sure you focus on ongoing commitment to keeping that ratio in check. Keep it low, keep it manageable. It's an overall metric in your financial health along with other metrics. So focus on that. Debt to income ratio is an important number to track throughout your life, especially when major events are happening, new loans taken on, buying a house, things like that. But definitely monitor it throughout your life. It's an important ratio among others to monitor and keep track of. And that'll help your financial health stay, focused in the right direction overall. All right. If you have questions about this or anything else, you always are welcome to reach out. My website is elevationfinancial.com. You can find me on pretty much any social platform as well. Or if you want to consider becoming a client or have further questions to just learn more about working with me, you can book a consultation, which is free on my website, which again is elevationfinancial.com. Thanks for joining me today. As always, have a great day. We'll see you next time.